Welcome to LR Reports. This episode is based on institutional research published by a leading global financial firm. We focus on the core investment thesis, key assumptions, and material risks outlined in the original report.
Welcome to the deep dive. Today we're conducting a structured interpretation of some pretty significant institutional research looking at the year ahead.
We are. We're going to be breaking down the Stifel Financial Core 2026 Outlook Report.
That's right, it was published just last month in December of 2025.
And our mission here really is to distill Stifel's core view. We want to understand their calculated corridor for the S&P 500, and maybe more importantly, the macro risks that are leading them to some pretty non-consensus recommendations.
Right. And before we jump in, we have to make something very clear. This discussion is solely our summary and interpretation of Stifel's research.
Yes, it's for informational purposes only.
And it absolutely does not constitute investment advice. We're here to understand their thinking, not to tell you what to do.
Exactly. So with that, Stifel kicks things off not with a single target, but with a wide risk parameter. They see the S&P 500 trading in a corridor between 6,500 and 7,500.
1,000-point range. That alone tells you a lot.
It tells you everything. It frames the year as one defined by persistent macro uncertainty. It's this high-stakes balance between some defined upside and some very tangible downside risk.
So that range signals volatility, but what's actually driving the uncertainty? Stifel seems to see 2026 as a real transition point.
A critical transition. Yeah. I mean, if you look back at 2025, they point out that the economy only avoided a slowdown because of that massive AI-driven capital spending.
The hyperscaler CapEx.
Exactly. That was strong enough to completely offset the slowdown they were already seeing in personal consumption.
So AI spending was the counterweight. But if that was the main thing holding the economy up, what happens now? What replaces that growth engine?
And that is the core vulnerability. The U.S. consumer is still a massive 68% of GDP.
68%.
And Stifel's view is that the growth rate of that hyperscaler CapEx,
right?
Well, it's likely peaked.
So a major driver of growth is fading out.
It's fading, just as the consumer's own financial strength is looking, increasingly tenuous. That whole late cycle dynamic is what's driving their caution.
And they actually quantify that caution. They put a hard number on the probability of a recession this year.
They do. They assign what they call a non-trivial recession probability of about 25%. And crucially, they don't just state that number. They actually use it to calculate their downside target.
The 6,500 number, I found that part of the report really insightful. It's not just a guess. It's a risk quantification exercise. Can you walk us through how they get to 6,500?
Sure. They're essentially weighting the risk. So historically, when a recession hits, the typical S&P 500 decline, they use the post-World War II trimmed mean, is about 20%.
Okay.
So you take that 25% chance of a recession, you multiply it by the potential 20% drop, and that gets you a weighted sort of priced-in negative 5% decline for the index.
Which, from current levels, lands you right at that 6,500 floor.
Exactly. It forces you to price in a guaranteed 5% risk premium just for the probability of that event.
It's a very clear way to define the downside. So let's flip it. What about the other side of that corridor? What has to go right to hit the 7,500 high end?
The path to 7,500 is almost all about earnings. Robust earnings growth, with basically no help from valuation.
So no multiple expansion?
None. Their model assumes about a plus 13% S&P 500 EPS growth for 2026. You combine that pretty impressive growth with a small PE pullback, maybe 1 point of compression, and that gets you a price gain of about 9%.
Right around 7,500.
Right.
But what's sobering about that, a 9% gain? That's just the average, isn't it? Stifel points out that's the average annual S&P gain for the last 60 years.
It is. The upside is, pedestrian. It's not a continuation of the kind of multiple expansion we've gotten used to.
Which brings us to what feels like the primary warning in the entire report.
Valuation.
Valuation.
Without a doubt, despite a reasonable bull case price target, the starting point is the problem. Stifel is very clear that the market is undeniably expensive. Specifically, they point to the equity risk premium, the ERP.
Which is sitting in the 92nd percentile over the last 65 years.
The 92nd percentile.
Yeah. So for listeners, just to clarify, the equity risk premium is the extra return you demand for the risk of owning stocks versus, say, a safe treasury bond.
Right. And if it's in the 92nd percentile, it means investors are demanding historically very little compensation for taking that equity risk. It suggests complacency, crowding.
And it screams fat tail risk, the low probability, high impact stuff.
It does. And they also mentioned the KPE ratio being nearly 3 standard deviations overheated. Historically, valuation doesn't matter until, it's the only thing that matters.
So how does the market structure right now feed into that fragility?
It's all about concentration. I mean, this market has been driven by big tech's massive economic profit, as they call it, the spread between their ROIC and their WACC.
So a handful of names are doing all the heavy lifting?
Precisely. Which makes the whole structure fragile. These cyclical growth stocks are trading at peak enterprise value multiples. And Stifel's point is that leaves, and this is a direct quote, no margin for error if earnings disappoint.
And we're already seeing warning signs from the more speculative corners of the market. They draw this really interesting parallel to the dot-com era.
The Bag 7. Yeah, I like that term. It's an intentional parallel to the sizzling 7 from the dot-com bubble.
The canaries in the coal mine.
That's the idea. Speculative assets often lead the way down. And they note that these so-called Bag 7 indices have already tumbled, which mirrors the pattern we saw just before the broader market turned down in the early 2000s.
So you have this dual reality, peak valuations on one hand and slowing macro momentum on the other. What's the strategic takeaway for positioning?
Their core argument is that the huge diversions we're seeing right now between cyclicals, which are being pushed up by big tech, and defensives, is just not compatible with a slowing economy.
That gap has to close.
It has to close dramatically. So the tactical recommendation is very clear. You need to hedge your existing cyclical growth exposure with defensive industries.
That feels very textbook late cycle. Which specific defensive areas are they highlighting?
It's a mix of what they call defensive growth and defensive value. So you're looking at things like healthcare, consumer staples, gold, waste management, and even some areas of software.
The kinds of industries that can hold up better if real GDP growth slows down.
Exactly. Their earnings are just less tied to the broad economic cycle.
So we've positioned the portfolio, but let's dig into the macro drivers. Let's start with inflation. The consensus view seems to be that we're headed straight back to the Fed's 2% target, but Stifel is really pushing back on that.
They are. They're challenging that whole aggressive disinflation story. Their forecast for 2026 is that inflation only gets back to the sticky levels of the early 1990s, something around 2.7% core PCE.
So not 2%.
Not 2%. And they're really fixated on one key component, supercore inflation.
Which is core services, but excluding housing. That's the really stubborn part, isn't it?
It's absolutely the most stubborn part. It's half of total PCE inflation, and it's highly sensitive to wages. Stifel's analysis finds that supercore is simply returning to its old pre-GFC range of about 3 to 3.5%.
So the idea that globalization-fueled disinflation is coming back, that's over.
For the foreseeable future, yes, which of course directly constrains the Federal Reserve.
Right. It raises the risk that the Fed cuts rates too late, or they make a policy mistake by easing into a slowdown.
The whole analysis hinges on the real Fed funds rate. So that's the nominal rate minus 1 year ahead inflation expectations. They see that getting to about 1% by the end of 2026.
Which is, to be fair, in line with the historical median.
It is. But the uncertainty is all in the timing. Do they get there fast enough to avoid the kind of shock that Stifel sees coming?
And what about liquidity signals? I know they mentioned Bitcoin.
They do. They use Bitcoin as a sort of proxy for risk-on sentiment that's driven by cheap liquidity. And they noted that Bitcoin may have already fully priced in all the Fed easing we're going to get.
So if the Fed doesn't ease more than expected, that liquidity tailwind just disappears.
It dissipates, exactly.
Moving on to broader conditions, they highlight a longer-term pressure on PE ratios from U.S. fiscal deficits.
That's right. It's a major structural headwind. The U.S. is running sustained deficits over 6% of GDP. And historically, that kind of spending creates rapid money supply growth.
Which then leads to PE compression.
It precedes waves of PE compression. It puts this long-term gravitational pull on multiples, really regardless of what earnings are doing.
And if fiscal policy is the long-term problem, the credit market seems to be a very worrying short-term disconnect.
A huge disconnect. Stifel calls it frothy credit. I mean, the tightness in credit spreads right now is basically implying U.S. real GDP growth of around 4% year over year.
Which Stifel finds
completely unrealistic for 2026. And this gap matters because if actual GDP weakens like they think it will, credit spreads are going to widen out fast, and that will translate immediately into a lower S&P 500 PE ratio.
Compounding the valuation risk we already talked about.
It all connects.
So let's talk about that risk framing. Stifel explicitly rejects the consensus view. What is the story they're fighting against?
They're fighting against the idea of a smooth handoff. That's the consensus. A benign transition from this tech-led growth cycle into broader cyclical strength. the perfect soft landing.
And they dismiss this. Why? Based on history.
Purely on historical precedent. They showed that from the current starting point with PE ratios this high, with the growth to value ratio, this stretched, smooth transition has simply never occurred.
Never.
Never. In past instances, these levels have often preceded full-blown bear markets. Their data just argues that a falling GDP and a rising concentrated S&P 500 are fundamentally incompatible over time.
So bringing it all back to the bear case, what are the two main downside triggers they're telling investors to watch?
It's all about the consumer and the labor market. First, any serious weakness in the U.S. consumer. And second, a sudden liftoff in unemployment. They stress that joblessness typically continues to rise after an upturn.
So we're in a very precarious spot.
Very. Labor supply and demand are falling together right now, which is masking some of that underlying fragility.
Which leaves us with a very asymmetric outlook for 2026.
Highly asymmetric. The calculated upside is modest, right? Plus 9%, driven only by earnings. But the calculated downside, which bakes in that recession probability, is only minus 5%. That relatively small downside, when you pair it with all the valuation warnings, that's the core message. The risk-reward for just owning the broad market is poor.
Which brings us back then to the strategic implications, to the discipline of selectivity.
It's the only mandate that makes sense in their framework. If you forecast slower U.S. real GDP, that naturally benefits defensive industries. So the recommendation is disciplined risk management.
Hedging that highly concentrated cyclical growth exposure,
which has ridden the AI wave with defensive groups like healthcare, staples, and software. The strategy is tailored specifically for this kind of late cycle peak valuation environment.
Stifel also zooms out, connecting 2026 to some much longer-term themes, particularly around the dollar and commodities.
They do look far beyond just this year. They forecast a slow, prolonged period of U.S. dollar weakness, sort of like what we saw from 2000 to 2010.
And a structurally weak dollar is historically a negative for the kind of growth leadership we have right now.
It is. And on the flip side, they notice cyclical bounce back in commodity prices. They argue that the 10-year growth rate for commodities should start to favor value over growth, and also small caps and non-U.S. equities over time.
Which just reinforces the need to diversify away from those really concentrated growth sectors.
It does.
And that revival in commodities actually sets up our final thought for today. Stifel uses that trend to frame a really provocative insight about geopolitical risk.
Yeah, this part of the report goes deep. They draw this powerful, long-term historical parallel between commodity cycles and political cycles.
Okay.
They observe that the revival of commodity prices is historically linked to a resurgence of populism. And populism, as they note in the report, is generally investor-unfriendly.
To say the least.
Right. And these populist cycles often precede periods of major geopolitical conflict. So while we're all here talking about PE ratios and inflation, the bigger structural story might be that the revival of commodities is signaling a much more complex and volatile decade ahead, one that goes way beyond simple macro data.
That is a powerful frame to consider, well beyond just the next 12 months. So to summarize Stifel's core message for 2026, you have persistent macro uncertainty, which dictates this balanced quarter view for the S&P 500 from 6,500 to 7,500.
And that highly asymmetric environment forces a tactical shift. It's about hedging the market's high concentration and cyclical growth with defensive strategies.
Driven by those rising risks around the consumer, peak valuations, and stubbornly sticky inflation.
And that concludes our structured analysis and interpretation of the Stifel Financial Core 2026 Outlook.
And as always, a final reminder, this content is for informational purposes only and does not constitute investment advice.
You have been listening to LR Reports. This content is for informational purposes only and does not constitute investment advice.